Welcome to Mortgage 101, where you will learn the important steps of buying or refinancing a home. Hello, I am glad you are here. My name is Nathan Rufty, a mortgage loan originator with over 25 years of lending experience that has your best interests in mind. After listening to this full podcast, connect with me to discuss your home loan needs. Now on with the show. Hello, and welcome to another very informative podcast with Mortgage 101. Hello, my name is Nathan Rufty, a licensed loan originator in the state of California and Arizona. Today's topic, we're going to talk about funds to purchase a home. The money you're going to need to be able to buy a house today. And there's going to be three areas that we're going to talk about. Is your upfront, your down payment, and your closing costs. So the upfront fees are what's the inspection fees, the appraisal and a home inspection. The appraisal is required by the lender. Sometimes we can get away with it depending on the program, but 99% of the time you're going to need to do an appraisal. And appraisals determine the fair market value for the home and make sure that if there's any health, safety, soundness, or security issues with the home, the lender will know about. So that is a requirement, and there's a fee for that as paid to a third-party individual, an appraiser, that he or she is going to get compensated for, and a home inspection. It's not required, but highly recommended that you do a home inspection. That's different from the appraisal. The appraisal is kind of an overview. A home inspection is more in-depth, and you'll pay for that out of pocket as well. In some markets, you can get away with those fees under $1,000 for those two. Now, if you want to do anything up and above that, like a mold, a septic, a well inspection, that's going to be placed upon the buyer if the seller does not elect to pay for those services. But for right now, just the appraisal and a home inspection, not required, but highly, highly recommended that you do that. If you elect not to purchase the property or something happens with the transaction, those two fees are non-refundable. Those get paid to third-party individuals and they will get compensated, and that money is gone. That's an investment fee. The second is going to be your down payment. Currently for FHA, 3.5%, conventional, 3%. And that's down 3% of the purchase amount, 3.5% of the purchase amount for FHA. USDA, not required for a down payment. You can bring some in if you want to bring in money for the down payment. And a VA purchase loan, no money for the down payment, but you have an option to bring in money if you want for the down payment. Now, you're going to open up escrow. When you open up escrow, they're going to ask you for a deposit, an EMD, earnest money deposit. So you're gonna connect with your agent, and you guys are going to agree upon how much you want to come in with a earnest money deposit. More money obviously is a better offer to the seller, but definitely speak with your agent about the EMD, earnest money deposit, on how much you want to bring in and give to escrow. That is a deposit. That money will be applied. It's not lost. That money is going to get applied to the overall cost of the loan, whether it be for the remainder of the down payment or the closing costs. Like if you open up escrow for $2,000 and you are doing a USDA or VA loan, there's no money for the down payment. But let's say closing costs are $5,000. That $2,000 is going to get applied to that $5,000. So what's left over is $3,000 for the closing costs. Same thing on a purchase. Let's say you're buying a $300,000 home and you're doing a conventional at 3% down. That's $9,000, and you come in with $3,000 for the earnest money deposit. That $3,000 is going to get applied to the $9,000. So what's left for the down payment is $6,000. So that's how that works. You're going to have, that's the second bucket. You got the first bucket, home inspection, appraisal, and any other septic or well or mold inspection out of pocket up front. You got your down payment money, and then you got your closing cost money. The closing cost is what the lender, title, escrow, and the per diem of interest prepaids are called for the buyer. So you're going to have those four buckets for closing costs: lender fees, title fees, escrow fees, and the buyer's prepaid items. And prepaids are the per diem of interest. And if you elect to do an escrow account where you pay your property tax insurance inside the mortgage payment, you got to start that account. So you got to fund it and kind of feed it to get it started. And then you got your lender fees, titles, and escrow fees. Those individuals will have charges associated with the loan, and they're going to be based on the purchase amount for the insurance. And escrow has a kind of a flat fee, but definitely talk to the agent about those charges. Those are charges the lender cannot negotiate, cannot talk to, because those are third-party vendors. Title and escrows are third-party vendors. Your prepaid items as a buyer, the interest, it is what it is, and the taxes and the insurance they are what they are. So those fees are going to be your fees that you need to shop around for the best insurance, and the property taxes are just the tax rate that's going to be on the home that you're looking to purchase. So those are your three buckets. You got your out-of-pocket upfront cost that's non-refundable. You got your down payment money, and you got your closing cost money. So talk to your lender on what's the estimated closing cost. Now, it's an estimate. It's not, you can't hold them to it. Hey, you said it's only going to be $9,000 and that's all I got. Well, they're going to change based on what the title and escrow fees are. So we give a good guesstimate on what those fees will be as a lender. So it gives you kind of a ballpark figure on what it's going to cost for you as the buyer to purchase the property with the down payment as well as the closing costs. Now, where can you get money? Let's say you don't have the money for the down payment. The upfront stuff, you got to. You got to have that money to do those services unless you get a gift. So for those down payment, though, the seller cannot give you, unless they're related to you, cannot give you that down payment money that's required. That money needs to come from your own funds, checking, savings, stocks, bonds, IRAs, mutual funds. It can come in as a gift from a family member. You can use a down payment assistance program for that required down payment. You can sell something of value, like a car that you're not using. Sell it, get the pink slip, and get the bill of sale, because we need to paper trail that money. I've talked about it in previous podcasts. In our business, cash is not king. Every money that you deposit over $500 needs to be accounted for. We got to have a paper trail on that. So you can't all of a sudden have cash money sitting somewhere in a cookie jar and you want to deposit that money and use it to purchase a home. We need it seasoned in your account. We can't have it there all of a sudden a week later and you show a paper trail of it and say it's cash I deposit. We can't use that. That's not how our industry works. Cash is not king. So funds can come from various sources. You can save, which means stop eating out as much. Entertainment, cut that back. If you're looking to purchase a home, remember, when you're buying a home, you got your upfront costs just to get the home. Then you got deposits on utilities and cable. Then you got to buy stuff. You want to repaint the house, recarpet it, add a shed, add a different shutters, curtains. That's all going to cost out of pocket. So when you move in the home, there's going to be added expenditures that you're going to want to customize your property to your liking. So how bad do you want to purchase a home? Start saving right now. Everything you can do to save money. Pack your lunch to go to work. Cut out the entertainment for now. Don't buy anything that you do not need, because that money can be applied towards the closing costs. We got two markets. It's either a seller's market or a buyer's market. That's it. There's no medium ground there. There's not enough inventory of homes for sale. There's too much inventory homes for sale. So that's where you got to look at what market that you're in, because you got to save money for that closing cost. If we're in a seller's market, which means there's not enough homes on the market and there's tons of buyers and there's less inventory, the sellers don't have to give away the farm for a buyer to purchase the property. So they're not going to give you the closing costs. It's how bad does the seller need to sell that property? Are they going to start giving stuff away? So that down payment has to come from you in some source. You got to find it. Like I said, stocks, bonds, IRAs, checking, savings, mutual funds. Sell something of value, jewelry, a car that you're not using, something that you can have a yard sale. Just start saving money where you can for that down payment, unless you're doing a VA, which is no money down, and also a USDA, which is no money down. But if you're doing a FHA or you're doing a conventional, 3% minimum of the purchase price for conventional and 3.5% minimum of the purchase price for FHA. You also can look at a down payment assistance program. We can explore those as well. So the next one is the closing cost. That can be credited by the seller. So the seller can give you money towards the closing cost. The lender can increase the rate. That can give you a lender credit towards closing costs. But you, as the buyer, must accept a higher interest rate. That's how lenders do it. Is the higher the rate that we give you, we don't make any more money. It just gives you a lender credit. So basically what you're doing is financing those closing costs within that interest rate over the fixed term that you elect to take. So the higher rate you take, the more money the lender can give you towards closing costs, but you're taking a higher rate for that. The seller can pay for your closing costs over a certain percent, depending on what program you're doing, but definitely speak with your agent on how to present in your offer. We don't have anything to do with present your offer as a lender speak with your licensed real estate professional. He or she is going to direct you in the right way on how to present your offer to the seller, if you need to ask for closing costs or not, or how much room is there, or what kind of market you're in. Are you in a buyer's market? You're probably going to get closing costs. If you're in a seller's market, you may get something from them, but don't bank on it. You don't want to bank on other people giving you money to purchase a property. How bad do you want to buy a property? You need to save, as the buyer, you need to save some money. Or sell something. So the closing costs can come from your own funds, stocks, bonds, IRAs, mutual funds, money market, sell something of value, just like the down payment can. The difference is the lender can raise the interest rate to help with the closing costs with the higher rate, and then the seller can pay for your closing cost as well. But connect with your agent about making an offer on how you're going to present it and ask for closing costs if you want to go that route. The lender will talk to you about raising the interest rate. But remember, if you're at the top of your budget on the purchase amount at a specific rate and you want lender credit on that rate, then the rate's going to go up, the purchase amount's going to go down. So that's where you got to speak with us lenders about is what do you want to do? How do you want to go about doing the loan? Do you need that closing cost money? And also a down payment assistance, even though it's called a down payment assistance, that down payment can also be applied towards the overall cost, whether it be for the down payment or whether it be for the closing costs. It's just going to go the overall cost of it, but you got to apply for the down payment. You got to get approved by the down payment as well. So those are some factors on where you can get money to buy a house. How bad do you want to purchase a home? And what you got to do is just curb your spending habit as a buyer. Or if you have people that's going to give you a gift, you can do that. Stocks, bonds, IRAs, mutual funds, a retirement plan, 401k, anything like that, a 403B, a 457, anything that you can get your hands on your own money to purchase a property, go for it. As long as it doesn't hurt you in the long run, get find money for the down payment as well as closing costs. But don't rely on the seller. Don't rely on the lender, because the rates may not be paying that much that day, or you need to go to the top of it and all of a sudden the rate's going to push you higher and you just can't. It just doesn't work. But don't bank on that stuff. It's nice to have that option if it's there, but don't bank on the lender increasing the interest rate or the seller paying your closing costs. Try to have those funds in the bank when you start looking for your home. At least talk to a lender and just give you a ballpark on what you need to save up for roughly X amount of dollars to purchase a $200,000, $250,000, $300,000, $400,000 house. How much ballpark money do I need to be able to buy a property for the upfront out-of-pocket cost, which is going to be $1,000 or less. The down payment, 3% minimum for conventional. You can come up with more, but it's minimum 3%, as well as at 3.5% for FHA of the purchase amount. So $300,000 purchase amount for conventionals, $9,000. 3.5% on a $300,000 house for FHA is $10,500. USDA and VAs, there's no money down for the down payment, but you need to talk to your realtor. You need to have something that goes down the EMD, the earnings money deposit. You just can't make an offer and, well, how much you want to open a escrow with? I don't know what the markets I'm in, they got to come in with some kind of an EMD. It can be $100, it can be $500. But the more money you come in as a deposit, as an earnest money deposit, that seller's can go, okay, this is a well-qualified, motivated buyer. I want to go with this individual. So you got to look at that with your your buyer's agent to make sure that you have enough funds, because the sellers are going to look for all that. Sellers are going to look with their agent, of course, look how strong that buyer is making an offer. You got to look at yourself that says, hey, if I'm offering $300,000, I got 3 offers at $300,000, but one person's coming in with $100,000, one's coming in with $1,500, and the other one's coming in with $5,000. That $5,000 earnest money deposit buyer is going to look a lot stronger to the seller, and they might go with that buyer. So those are the things you got to speak with your professional realtor about, is make sure how you present your offer in the right way. But us lenders, before we issue that pre-qual letter or pre-approval letter, we want to make sure the numbers are all going to be there. You have the credit, you have the income, and you have the assets. The assets mean you have the down payment and you have the closing cost. If they're not there, what are you looking at for houses for? So if we're relying on the sellers to pay for some of your closing costs, you, me, and your agent, we all got to be on the same page for that, knowing that that's where the funds are going to come from, and you got to present these offers in a manner that's going to be acceptable to you and your agent. But we got to have the down payment. So if we need to save up some more money, it takes you as the buyer To save that money, you got to cut out expenditures. You got to cut out entertainment. You got to cut out going out to dinner. Food. Food's the biggest one that I see on bank statements, and entertainment. I mean, it's drive-throughs. It's the supermarkets. It's supermarkets mean that's going every week and spending quite a bit of money. But if you don't need those things right now, don't buy them. What's more important, a house or going to the drive-through every single day? I see that on bank statements, and it's not everybody that does that. It's just you as the buyer must look at those things that say, what can I cut out of in my daily life, weekly, monthly life that I need to save for the down payment and possibly some closing cost. So thank you for taking the time out, listening to this podcast about where can you get money for the down payment, closing costs, and upfront out-of-pocket costs that is non-refundable. Those are your three buckets. Your upfront, home inspection, appraisal. Second bucket is your down payment. Zero money down for the down payment for VA and USDA. 3% for conventional minimum, 3.5% for FHA. You can put more if you like, but those are the minimums. Then you got your closing cost buckets. You're going to have your lender fees, title fees, escrow fees, and then your prepaid items, buyer's prepaid items that encompasses the per diem and for tax and insurance. And you need to pay your insurance up front 1 year for the homeowner's insurance. So if your homeowner insurance is $800, you got to pay for that up front. And these are all up front. We cannot finance your closing costs in that purchase amount. The only program that will allow us to finance your closing costs is the USDA. And the only way to do that, though, is if you're buying it for $210,000 and it appraises for $220,000, then we can use that $10,000 freed up equity for the finance those closing costs. So that's the only one that allows us to do that is the USDA currently. But it must appraise higher than the agreed upon purchase price for allow us to finance your closing costs with that freed up equity. VA, FHA, and conventional cannot finance your closing costs. Those are out-of-pocket monies that you got to come in with to close escrow on your property. My name is Nathan Rufty. Thank you for taking the time to listen to me on the down payment. If you really buckle down and you want to purchase a property, the money will come. Get a grant, get a gift, stocks, bonds, Irish mutual funds, sell something. How bad do you want to purchase a home? Let's start finding some money on where you can capitalize on that and start saving the money to purchase a home. If on your timeline and goal that I want to purchase a home in 6 months, this is what I need to do. Talk to your local lender. I'm licensed in California, Arizona, and let's put a plan together and say, if you want to purchase a property in the next 6 months and this X amount, this is how much money, ballpark money you're going to need to buy it. Let's start saving it. Thank you very much for taking time to listen to me. All my contact information is below if you're looking to purchase or refinance a property in the state of Arizona or California. Thank you again for taking the time to listen to this very informative podcast. Remember to subscribe, share, like, and comment. There is no better time than today to explore your options to purchase or refinance a home. Please call, text, or email me at the information below to get started right away, and I look forward in hearing from you.